Hello and welcome to our Talking Point. Now, this is the gathering place of future millionaires who want to get the insight knowledge on becoming a successful property investor. We release a new interview every week, which covers the finer details of becoming an investor. Now, at the Wealth Masters Club, we've been in operation for more than 20 years, and we've been helping ordinary South Africans to understand the property investment market. And we have helped to create the correct structures to become those successful investors. But a little more on that at the end of the video. So the core principle for a successful investment portfolio is always to ensure that you have the correct structures in place to protect your assets and investments. Now, without this, you simply cannot grow your investment portfolio comfortably. And the base that everyone needs to understand is the correct trust structure. Now, a trust is often misunderstood, but we aim to help educate you to understand the importance of this structure. And today's topic, we'll be touching on one of the elements of a trust structure, namely the loan account between the investor and the trust. And joining us today is one of Destinata Accounting's brightest minds, Christo Theron. So Christo, thank you so much for joining us today.
Hi, Damien. Thank you very much for this opportunity and welcome to all our listeners.
Great. Now, diving into the questions, can you please explain in brief the principle of a loan account between a trust and a trustee?
Of course. So let's say you have opened a trust and you are the trustee. This trust at the moment is completely empty. Let's say that you decide you are going to sell your assets to the trust, for example, 500,000, but the trust has no income or any means of paying for these assets. Thus, there's a credit loan account created between the trustee and the trust. This loan account states that the trust owes the trustee 500,000. The loan account shows the balance of the loan between the trust and the trustee at the end of the year. It also records the movement of funds between the two. Any payments made from the trustee to the trust to fund expenses, for example, you pay the accounting fees through your personal name, but it is for the trust. These payments will be allocated to your loan account to show that the trust owes you those payments.
Now, Christo, why is it necessary to form a loan account for the trust, and what are the benefits of doing this?
It's not necessary to form a loan account. As stated, a loan account is the result of payments made to and from the trustee to the trust. One of the benefits of a credit loan account is that this amount will form part of the trustee's estate as an asset. But with the double trust structure, we do advise that the loan account should be only between the family trust and the trustee. If you have two or more trusts, the trust can distribute funds from one trust to another through distribution accounts. The reason for creating a loan account in the family trust is that there's only a connection between the trustee and the family trust, and to disconnect the other trusts from the trustee.
Now, with most accounts, there's obviously an element of interest being accumulated. How is this calculated on a loan account for a trust?
So once the financials have been compiled and all the amounts are allocated and accounted for, we get the tax rates from the SARS website. So we use the SARS tax rates to calculate the interest. We then create a spreadsheet with the information of your loan account. We insert your opening balance, if there is one. We then allocate the amounts between the debit and the credit on the spreadsheet. Credit increasing the loan account and debit decreasing the loan. The interest is then worked out through formulas on the spreadsheet and then brought into account.
Now, how does one declare the interest on a loan account to SARS?
So if your terms for a loan stated that you have an interest-bearing loan, the interest on loan is declared once the trustee's personal taxes are filed. You will need to notify your accountant during your personal taxes that you have received interest on your loan account. Let's say, for example, after your donation of 100,000, you still have 30,000 left and need to declare it. You declare this amount by going on your SARS e-file profile and opening the year the interest is applicable for. On your form wizard, there will be an option stating that you receive interest, local or foreign. Click yes on this option, then scroll down to the income received. go to the interest received. Once you have scrolled down, there will be an add button on the right, and you add the interest received there. Your personal accountant will know how to declare this interest.
And then, Christo, my final question for today is, in your article from last week, you mentioned Section 7C of the Tax Act. So can you please give us a little bit more detail about what that is and what the actual act entails?
Of course. So Section 7C is the deemed donation. Section 7C was introduced with the aim of restricting taxpayers from transferring wealth to the trust by means of interest-free or low-interest loans. Section 7C, which applies from 1 March 2017, it started in the 2018 financial year, deems the interest on a loan made to a trust to be a donation that attracts donation tax. Basically, Section 7C was brought into account because if you were to invest that capital that you loaned to the trust, you would have received a minimum interest on that capital at repo rate +1. For example, if you invested that capital into the bank or let's say an investment company and the repo rate was 5%, you would have received a minimum of 6% that year. Now, to declare a deemed donation, an IT 144 form must be submitted to SARS with your calculations of the interest, plus your proof of payment. This needs to be done within 30 days of the deemed donation made. Thus, it is important to have contact with your accountant and to make sure you're up to date with your loan account balance.
Fantastic. Thanks, Christo. Now, as I said at the start of the video, the Wealth Masters Club aims to help educate and grow your understanding of property investment. But the best and most powerful investors are the ones who continue to learn and grow their knowledge. Now, we are offering a free online training taking place this weekend in both English and Afrikaans, which gives you an overview of how to create the correct structures, as well as an in-depth look at the property trends and why we invest in the type of units we do. So if you want to register for this, please make sure you click on the links below in the description and you will get your access to this weekend's training. Christo, thank you so much again for joining us today. We really appreciate your time.
Thank you very much, Damien.
Great stuff. And until next week, we'll see you guys soon. Bye-bye.